but they've really conceded the war because they know that fighting it will do too much collateral damage. So we're going to have runaway inflation. Inflation is going to keep getting worse. Ultimately, that's going to destroy the dollar's role as the reserve currency.
In today's interconnected global economy, navigating uncertain waters requires a keen understanding of economic principles and foresight into potential pitfalls. In this video, we delve into the insights of renowned economist Peter Schiff as he dissects the current economic landscape and offers a stark warning about the path ahead. From the specter of runaway inflation to the dilemma facing central banks, Schiff's analysis provides a roadmap for understanding the challenges and choices confronting policymakers and investors alike. Join us as we explore the implications of Schiff's perspectives and contemplate the crossroads at which our economic future hangs in the balance.
You buy gold as an alternative to U.S. dollars or U.S. treasuries. Foreign central banks are selling their dollars and buying gold. And why are they doing that? They're foregoing the interest that they could otherwise earn on treasuries to own a non-interest bearing asset like gold. Well, the main reason to do that is if you believe inflation is going to be higher than that interest rate, that means you have a negative yield and you're going to lose purchasing power if you stay in dollars or in treasuries. And so they are selling and they are buying gold. Look, the price of gold in the 1970s went from $35 an ounce to over $800. Right? That's not a coincidence that happened during the year or the decade of all this inflation. And what gold is doing, but it wasn't gold that was going up. It was the dollar that was going down. Like, for example, oil prices in 1970 were about $3 a barrel. In 1980, they were $30 a barrel. But the difference was in 1970, we paid in gold. In 1980, we paid in paper. And so it wasn't that the oil price was going up. It's the money that we were using to buy oil was losing value. And so we had to pay more dollars to buy the same barrel of oil. I mean, that's why you mentioned women working. This was my comment on women, in the workforce. The main reason that so many women entered the workforce during the 1970s was inflation eroded away the value of their husband's paychecks. And so because inflation caused the husband's paycheck to lose so much purchasing power, his wife had to get a job to make up the difference. Now, part of it was also rising taxes. There was a lot of bracket creep during the 70s where inflation pushed people into higher brackets. But it's not like, women were just all liberated and all wanted to work. They were liberated when they didn't have to work. They got forced to work because it was the only way to pay the bills.
Peter Schiff states that in previous economic challenges, such as those seen in the 1970s, families were able to endure by relying on a spare laborer, typically a spouse or family member, who could enter the workforce to supplement income when needed. However, according to Schiff, the current economic landscape paints a different picture. He argues that with a significant portion of households already reliant on dual incomes, there is no longer the option of introducing a spare laborer into the workforce to mitigate financial strain. Consequently, families are forced to navigate economic challenges without the safety net of an additional breadwinner. Schiff further contends that the prevailing trend of job creation, primarily consisting of part-time positions, often taken by individuals who are already employed, signifies a weakening labor market. This situation compels individuals to take on multiple jobs, resorting to moonlighting simply to meet basic financial needs like rent and food expenses. He suggests that the proliferation of part-time and multiple job positions reflects a deeper underlying issue: the erosion of job quality and the inability of the labor market to sustain households with stable, full-time employment opportunities. According to Schiff, these trends not only underscore the fragility of the current economic environment, but also raise questions about the sustainability of such employment patterns and their implications for broader economic stability.
We have to appreciate the fact that really, in earnest, it started in 2001, 2002, after the dot-com bubble burst, right? That's when the Fed first lowered rates to 1%. I mean, Greenspan made a lot of policy errors in the 90s as well, and that's kind of why the stock market bubble got as big as it did. But the policies really went to, the sublime in '01 and '02 with the rate cuts that gave way to the housing bubble, which led to the '08 financial crisis. But every time the Fed creates a misallocation of resources, malinvestment bubble, every time it pops, instead of allowing the market to fully correct for all the mistakes that were made in the past, right? The recession, as far as the business cycle goes, this boom-bust cycle, the boom is where the mistakes are made. The bust is where they get corrected. And you have to allow the market to do its job. But in the short run, that's painful because people lose their jobs, they lose money, and the voters don't like that. So there's always political pressure on the government, the Fed, to try to fight a recession when the recession is the cure. So fighting it simply makes the disease worse. But what they do is they keep creating more inflation, and it's kicking the can down the road and postponing the inevitable pain. But every time they do that, they make the underlying problem worse, and therefore the ultimate pain to resolve it, right, worse. And so my point is we are now at the final crossroads where the Fed has to pick the lesser of two evils, right? So on the one hand, it can fight the inflation that it created, with QE and all this, the expansion of its balance sheet. It can fight the inflation.
Peter Schiff predicts that the looming recession will bring about catastrophic consequences, including a crash in both the housing and stock markets, leading to a cascade of defaults and failures. He asserts that unlike the 2008 financial crisis, there won't be any bailouts this time around. Instead, banks will be allowed to fail, and depositors will incur losses. Schiff emphasizes that the government will be unable to honor its commitments to Social Security and Medicare recipients due to insolvency. He notes that Social Security trust funds are already selling treasuries, and the government is running a staggering deficit of $3 to $4 trillion annually. Even substantial tax increases on the middle class won't suffice to cover the shortfall. As a result, deep cuts to government spending will be necessary, posing significant challenges for those reliant on Social Security or who have lost savings in banks. Suggests that if the Federal Reserve aggressively fights inflation, the nation might struggle to pay the interest on its national debt, potentially leading to default. He argues that politicians are reluctant to make the tough choices required to address these issues, leaving the alternative of allowing inflation to continue unabated. However, Schiff warns that such a strategy will ultimately result in runaway inflation, undermining the dollar's status as the reserve currency and eroding the value of Social Security benefits. He concludes by highlighting the real losses that inflation will impose on all government creditors, including bondholders and dollar holders.